103 million ounces. That is what exists. 429 million ounces. That is what is claimed. Those two numbers cannot coexist without something eventually giving way. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Gold is at $4,291 right now. Silver is at $67.79. The Federal Reserve just signaled one cut, maybe zero, for all of 2026. The DXY is at 99. The 10-year Treasury yield is at 4.37%. And Shanghai is paying $11 more per ounce for physical silver than COMEX says silver is worth. The data is doing the talking. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now, subscribe to OG John AG 1.0, and share this with one person who needs to see these numbers. Now, back to the data. Lead story today, the Federal Reserve, March 18, 2026. Rates held unchanged. That was expected. What was not expected was the tone. FOMC projections flagged elevated upside inflation risks directly tied to the Iran-driven oil shock. The median dot plot shifted, one cut projected for 2026. A growing minority of FOMC members now project zero cuts. Zero. For precious metals that had been pricing in a full easing cycle this year, this was a structural repricing event. Not a minor adjustment. A structural repricing. The 10-year Treasury yield responded immediately. It climbed to 4.37%, its highest level since July 2025. Real yields, the actual competitor to gold and silver, rose in lockstep. The investment case for holding a zero-yield metal weakened in direct proportion. The timing is what deserves scrutiny, not the decision itself, the timing. The Fed delivers a hawkish pivot on March 18th. Oil is already above $110 per barrel. The Iran conflict is now in its third week, and gold, the traditional war hedge, is down 14% since the strike began. Think about what that sequence actually means. The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. The last time COMEX registered silver inventory shed 1/3 of its peak level in 6 months. Silver was trading below $20 per ounce. That was 2020. Within 18 months, it had tripled to $29. The registered stock today started this drain from a much higher base. The drain is happening again. The data is already telling you something. Let's build it out. Now let's build the full picture, and because the Fed decision does not exist in a vacuum. COMEX warehouse reports published daily by the CME Group show registered silver at 103 million ounces as of the most recent report. That is the metal physically available for delivery against open futures contracts. Total open interest on COMEX silver, tracked through the CFTC Commitments of Traders report, stands at 429 million ounces in paper claims outstanding. That is a coverage ratio of approximately 24%. 1 physical ounce for every 4 paper ounces claimed. 1/3 of the registered pile has been withdrawn since the September 2025 peak. That withdrawal has been consistent. One direction, 6 months straight. The April 2026 COMEX silver contract, tracked through CME Group front-month data, enters its first notice period in approximately 7 business days. Approximately 1,927 contracts remain open. That represents 9.6 million ounces of potential delivery demand, against a registered base of 103 million ounces. The Shanghai Gold Exchange AG T+D contract, which requires physical settlement, is currently pricing silver at approximately $78 to $79 per ounce. COMEX spot is at $67.79. That is an $11 differential, a 12 to 16% premium, paid by real buyers for real metal, with real delivery. The rate of registered stock withdrawal is not slowing, it is compounding. The ones who have been called alarmist for pointing at the 24% coverage ratio, they are not saying much right now, and here is what makes that picture even harder to ignore. The COMEX open interest of 429 million ounces represents paper claims. The system functions because the vast majority of those contracts are rolled or closed, never resulting in physical delivery. That is how it is designed. But the registered warehouse base has been declining for 6 consecutive months. At the same time, Shanghai buyers are paying $11 above the Western paper price. That is not a contradiction. That is the setup. And before anyone takes that as a green light, setups can take a long time to resolve. This could take weeks. It could take months. What this tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Here is the number most people are not talking about: 21 million barrels per day. Through the Strait of Hormuz. That is the daily oil throughput through one of the world's most strategically vulnerable choke points, according to the U.S. Energy Information Administration. The Iran conflict is now in week 3. The strait remains operational, but vulnerable. Oil is trading above $110 per barrel. Global inflation expectations have repriced accordingly. Now the macro variable, because this is no longer a backdrop, it is the primary variable. The Federal Reserve's own summary of economic projections, published March 18th, explicitly cited elevated upside inflation risk from the energy shock as a reason for holding rates. The DXY, tracked through the ICE US Dollar Index, has gained nearly 2% since the Iran conflict began. It now trades at 99. That gain has been unusually persistent for a geopolitical-driven dollar move. War-driven dollar strength typically fades within days. This has not faded. That tells you something important. This is not just a fear bid. This is a genuine repricing of the rate path. For U.S.-based investors holding gold in dollars, a stronger dollar reduces the metal's relative appeal versus yield-bearing Treasury alternatives. For international buyers in Asia and Europe, a stronger dollar makes dollar-priced silver more expensive in local currency terms. Import demand softens at the margin. Meanwhile, oil above $110 feeds directly into manufacturing cost inflation, energy input costs, and consumer price pressure globally. Markets are still pricing some probability of a 2026 Fed cut. Look at the 10-year yield at 4.37% and the March dot plot, and tell me what probability you put on that. When markets fully price the reality of what the Fed's March projections are actually communicating, gold reprices lower near term. Real yields reprice higher. That is the historical pattern. Every time a hawkish Fed pivot has collided with a commodities inflation shock, precious metals have faced short-term selling pressure before recovering. It has not been different yet. Gold Western spot at 4,291. Session low at 4,477. Shanghai Gold Exchange spot trading near parity with COMEX for gold. Modest premium, not the structural signal silver is showing. Silver Western spot at $67.79. Shanghai Physical at approximately $79. That is the $11 premium. The short-term picture is this. If the DXY holds above 99 and the 10-year yield holds above 4.20%, both metals face continued financial headwind. Paper selling pressure from leveraged longs unwinding will dominate the short-term tape. If oil pulls back meaningfully below $100, rate cut expectations revive, real yields soften, the dollar retreats, and both metals recover sharply. That is the only short-term read that matters right now. As for trading this on lower time frames, the data does not show a clean picture. Silver has moved more than $5 in a single Sunday session, with no futures market open to absorb it. Gold's weekly range has been over $300. That is not a tradable environment for most participants. I cannot tell you what silver does on Monday morning. Nobody can. Sidelines is not weakness in this environment. It is the only edge there is. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. 1. The Fed has explicitly removed near-term rate cuts, pushing the 10-year yield to 4.37% and raising the real cost of holding zero-yield metal. 2. The DXY at 99 is a 2% gain sustained over 3 weeks, reducing international silver and gold demand in local currency terms. 3. Silver carries industrial demand exposure, and $110 oil creates a global growth slowdown risk that softens solar, EV, and electronics silver demand simultaneously. The bull case is equally real. 1. COMEX registered silver at 103 million ounces against 429 million ounces in open interest, is a 24% coverage ratio with 6 consecutive months of registered stock withdrawal. 2. Shanghai Physical Silver at $79 versus COMEX at $67.79 is an $11 premium paid by real buyers in the world's largest physical market. That divergence has historically resolved upward, not downward. 3. April 2026. First notice day arrives in 7 business days with 9.6 million ounces in potentially deliverable contracts still open against a draining registered base. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything shown today points to one thing. The structural pressure in silver is already built. The COMEX registered drain is already happening. The Shanghai premium is already real. The only question is whether the paper market catches up to what the physical market already knows, and when. Don't take my word for it. Verify every number given today. Check the data yourself. CME Group COMEX warehouse reports at cmegroup.com. CFTC Commitments of Traders report at cftc.gov. Shanghai Gold Exchange data at sge.com.cn. U.S. Energy Information Administration Strait of Hormuz data at eia.gov. Logic over hype, always. If this analysis added value, like this video right now, subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. Drop OG John AG in the comments right now if you are here paying attention and actually learning. OG John AG 1.0 out.